Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day. Ira Epstein of Linn & Associates with your metals market update for this Monday, the 22nd of January, 2018. And we're just after 5:05 p.m. Central Standard Time. Gold's up a fraction tonight. Silver's up a fraction. Same with copper. Platinum. Platinum got hit today, almost down at one point over $20, settled nearly 20 lower, and it's bouncing up a little tonight. Pretty much unchanged in the currencies, and now that we've got the Senate that passed the bill to reopen the government, the House claims that they have the votes already. It's going to go right to the president's desk after the House, and what will take place from there is the president signs it, gets on a plane, goes to Davos, and then the fun begins. What's he going to say to either offend or get people on his side? You just never know. But in looking at the markets, we now have another extension only through February 8th, and that'll weigh on the markets. But the biggest event's going to be the European Central Bank, Bank of England, and other central banks' monetary policies that are all coming up for play now. So keep yourself open to all that because that's what's going to affect things. When we look at a weekly chart of gold, you can see how you flattened out against the 1337 level, and you just sort of backed off now about $5 from that high, down right now 30 on the week. Not much going on there. On the April gold, and I've moved to the April contract, you still have the area chart of closes in what we call that up thrust. Take out this low back here, and I'll give you that number. That would be 1329.10, and I'd have to, on a closing basis, then say you're into a down thrust. Maybe you make it to the 18-day average of closes. Get up and over this number right through here, and you might want to know what that high closes. That one's 1344, and the game is on in terms of how high is high. When we look at this chart right now, you can almost visualize a downtrend here and an uptrend going right through there. Do you see that? Just visualize it because that's probably what you're dealing with. You certainly have the pattern of higher lows so far and lower highs. You do see that. But I'll call the trend up because the pattern has been higher lows, higher highs, and admittedly, we've entered a pause stage unless you can clear 1342.70. In terms of where the support is, I just mentioned it's the 18-day average of closes. If everything gave ground, maybe the 100-day would come into play. And we go to the Bollinger Bands to see just where theoretical resistance and support comes in. Now remember, for those of you that might just be watching me for the first time, these black dashed lines are an algorithm called Bollinger Bands. And behind the theory of this is that the market will trade within those bands 95% of the time. They typically go the other 5% after sideways action has occurred. It doesn't always work that way, but more times than not, you'll get sideways pattern in the market, and from the sideways pattern, you either burst to the downside or to the upside. Many other parts in between there, but I'm giving you the simplistic point of view on it. When you look at the slow stochastic study, first of all, it's a momentum indicator. It's no different than what is moving average convergence divergence. Too complicated. What is a slow stochastic? Again, why don't these people name things that we understand what they are? But it's the way it is. So a slow stochastic indicator, first off, implies there's a fast stochastic indicator, which there is. It's all the timing and how you're looking to see how these lines crisscross on each other. A slow stochastic momentum, let's just call it the momentum indicator, is made up of two lines. When either of those lines are over 70, I consider, and this is my own take on it, the market is overbought. So how I'm viewing gold is it is a market that's in an uptrend. It has upside bias because it's trading over what I call the line in the sand, the 18-day average of closes, but it is in an overbought condition, and that's caused the market to pause for a bit here. When you look at Bitcoin, this is that sideways action, and you'll notice the market broke out to the downside. Each bar on this chart is 15 minutes. So I'm just trying to give you a feel that, yes, you can take some markets and work with them in a different schematic than you do on a daily chart. And that's up to you to work with. But this is what this market did. Came down, it shot back up, it got oversold, it's back over the 18-day average, and that's where I'd expect to see some resistance. But it's been getting beaten up pretty good recently. When we come to the gold-silver ratio, I look at this to get a feel, is silver stronger or weaker than gold? If silver is weaker than gold, this number should be going up because you need more ounces of silver to buy 1 ounce of gold. So right now, you need 78.4 ounces of silver to buy 1 ounce of gold. Therefore, back here you needed 75, so as silver fell relative to gold, the ratio moved up. I also look at ETFs because sometimes they give you a better indicator than the futures. I look to see, does one lead the other, or are they just going hand in hand? In this particular case, you still have what's called an embedded reading. Now let me explain the difference. Remember when we went to the gold, we saw readings in the 70. Now you've got both numbers in the 80. Unless the red number closes back under 80, when the numbers go sideways over the 80 level, I consider that to be bullish. And the market has converted itself from going up to locking in a bull trend. I was going to say overbought. Overbought occurs when the red line closes back under 80 after you've had that sideways action. So markets rarely go from a momentum up, let's call it, to embedding, and just all of a sudden in a downtrend. They'll get overbought, and then they work off the overbought condition. When you look at the GDX ETF, if you knew nothing else and you were up here, you were in an overbought market that hit the upside target of the Bollinger Bands. If prices were to fall back, and I have no idea if they would at this point, you have two support zones. The 18-day average of closes, 23.39, and the 100-day at 23.20. The market falls, gets as low as 23.56, hangs in there on Friday, but you're still not through. If the market comes down, now I'm looking still for that 18-day average, which it went down to today, went through by 2 cents and held. Okay, so we have a low back here at 23.56, another low at 23.54. Believe it or not, the trend can turn up in this market if you were to take out yesterday's high, Friday's high of 23.84, and not get back under 23.56. Wait a minute, I said that actually wrong. If that's 23.56 and this is 23.54, the trend turned down. I said that all wrong. Let me correct it. Lower highs, lower lows on the swing line's a downtrend. Now let's correct my other part. The 18-day average, when you're over it, it measures you have upside bias if you're over it or downside bias if you're under it. The market hit it and kept the upside bias. Should prices continue down, then I'm looking for the 100-day average. Let's flip-flop this. Let's assume you take out this 23.80 and a fraction number. You would not turn into an uptrend on the swing line because you'd still have a lower low and a higher high. Got it? It's good to do this with you sometimes. In the silver market, I want you to look at this heavy gray line that I've got right here, not the black ones here or there. This one is the 200-day moving average of closes, and it's been acting as a barrier on silver for a very long period of time. Now, I don't always look at 200-day averages, but this is just so evident in the market that I can't get away from it. And as you can see, you've got a pattern here of higher lows and then lower highs. Now, if we come back to this low, let's do this together. That low, 1691.5. Then you bounced up on Friday, and today's low is 1694.5, and tonight you're up a little bit. This market could turn bullish if you were to get over right here the highs of this day, which were 1713, and just not get back under whatever this low of 1694 is. But momentum is pointing down, the bias is down, and the market is looking for direction, and it's pretty clear what's going on. Battleground. Let's assume you don't rally. Let's assume you break. If you break down where do you think the support is, I think it'll be this lower Bollinger Bands right in here under the 1700 level. If you clear the 1713 and don't take out 1694, then one of the potentials to the upside might be the upper Bollinger Band, 1735. You're in this wishy-washy time in the silver market. In the copper market, you have a market that is number one oversold. Now, remember we said if both numbers, when we're talking on the bull side, are over 80. Here we have both numbers under 20. It's the flip side of it. Both numbers were under 20 on Friday, not the day before. Therefore, we need another day where both these numbers stay under 20 to convert the market from being oversold to locking in a bearish trend. If that occurs, we still target the lower Bollinger Band. If that were to give ground, the 100-day average is right here. What if the market rallies? Well, the first resistance point is the 18-day average of closes. Is this a clean chart? Just like silver, no, because you got higher highs, lower lows. It's a difficult chart trying to figure out what it's going to do. In the platinum market, you had a huge down day today. If you take a look, the market's range, you went from 1023.90 to 994.80, closed down $23 on the day. As you're opening tonight, even though you're higher, you're losing that embedded reading. See that 77.90? If the bulls are going to support this market, they literally have to drive it up right now. Any lower moves in the market could carry back to the 18-day average of closes. So let's assume a market goes to the 18-day average. You ever play a pinball machine? And these are popping up again. I mean, when I was a kid, we played them, and now they're popping up all over Chicago in storefronts. They're bringing in the old machines again, and kids are all addicted. Well, you're shaking them. You got a ball that's going in them. And if you shake it too much, it tilts. There's a reset button. You press the reset button, and the game comes back on. I consider the reset if you hit the 18-day average of closes. It's also what I call that line in the sand. It's a very important number. If the embedded reading is lost, often prices try to get back and reset. In the palladium market, you lost the embedded reading right here. This is what I'm trying to teach you right now. And there's a 78 reading. Before that, we had all these readings over 80 consecutively. When it was lost, I was saying the odds favor price and the 18-day average are going to come together. Well, it took time. And you would have said, Ira, you're completely wrong. Look at the higher highs you're making, and I'm agreeing with you. The problem is my work still is saying the odds favor. They're going to come together. Momentum is now corrected, past tense, an overbought condition as soon as the numbers get under 70, and look what happens. You went down there Friday, and well, actually today, and now you're trying to hold that number. This is the reset area, as I call it. And at the same time, you're bringing in the Bollinger Bands, and they're going to probably force this market to do some sideways action. I can't promise it'll be, but that looks like it. In the dollar index, you have a bearish embedded reading, and since you've developed that, the market's had the pattern of lower highs, lower lows. I would not be surprised if we challenge the Bollinger Band again, just the way you did here. Then you bounced away, and you're coming down. I want to remind you about my market research because what's going to happen very shortly is I'm going to hold that first webinar I have been talking about. I haven't held one in a year. And what I used to do is hold them on a regular basis, and people could come in, ask questions. There'd be lots of people in the webinar room, and away we go. So I'm inviting you, and it'll be very shortly. How you'll get your invite is by email primarily. If you've signed up for our market research or any of our past products and didn't want to be taken off our mailing list, you're going to get an invite to this. It only handles 100 people at a time. That's my design. I got to be able to control the room. So if you're interested, just be ready for that to come. In the meantime, at any point, if you haven't had my research or the Linn research, give yourself a try. Take a look at our website. Go to www.iraepstein.com. You'll see a carousel of free offers on the front page. Choose what you want. Click up here. Or underneath us, you can click. It says, click here for Ira's free offers on a number of web pages. Do so, and we'll take it with you. I'm Ira Epstein. Looking forward to starting that first webinar. It'll be very shortly. You take care now.